All right, welcome back. We're going to continue our journey through dealing with control and consolidations with, well, what effectively is the starting point of the whole process. That is the acquisition of that controlling interest, which we, well, creatively enough, call the acquisition method. So let's take a look. So anytime we are combining businesses in which a parent or investor, whatever you want to call them, is establishing control over its investee, which becomes its subsidiary, there are two key characteristics which we follow. Number one, 100% of the net assets acquired. That does pay no attention to the amount you actually control. So even if you said, well, I only bought 70%, doesn't matter. When we do the acquisition method, you are buying control of. So you are in point of control buying the whole thing. So you record the whole thing. And if there's any balance of what you're buying that you can't allocate to specifically identifiable assets or net assets, that's going to be how we end up with goodwill. And when we consolidate the parent and subsidiary, or the investor and the investee together, everything in the subsidiary's equity, everything, will be eliminated in consolidation, meaning it's common stock, any additional paid-in capital, and any and all retained earnings. And we'll talk a little bit more about elimination on the slides ahead. Here's the thing to remember. The parent's basis in the subsidiary is the acquisition price, or a different way to think about it is whatever the fair value is of what you bought is what you should have paid for what you bought is ultimately what the value of your investment is in what you bought. So those numbers are all basically synonymous. But that gets me to one of my favorite mnemonics, and yes, we really do have favorites if we're Becker instructors. But mine is CAR in big. You're probably going and looking at me going, really? That doesn't even roll off your tongue, does it? No, but it is an excellent way to remember all the elements that make up a standard eliminating journal entry, or EJE. That's often how we refer to a consolidating worksheet with those entries, because that's what we're doing. We're eliminating things that otherwise would compel us to count something twice. We don't want to do that. So here's the way we structure it, and it's worded that way for a reason. CAR in big. So CAR is everything affecting the subsidiary's equity being eliminated. In is how we deal with both eliminating the parent's investment in the sub, but this is also how non-controlling interest is brought into the light. And then finally, big is all about fixing the balance sheet to fair value, and that's where goodwill can emerge. Couple key points there, and the way I said it. The N and the G, the non-controlling interest and the goodwill, they don't appear on the parent's books, nor do they appear on the sub's books. The only time we see them is when we're consolidating. So the only time we actually appear those accounts is in this eliminating journal entry. So let's backtrack. Let's start with the first three letters. That's the CAR. C for common stock, A for additional paid-in capital, R for retained earnings. The full balance of those accounts are eliminated. Now, that pre-acquisition equity, therefore, is never carried forward. It basically, in effect, the subsidiary's life kind of ends at the point it's acquired because its fundamental nature has now changed. So the consolidated equity will be the same as the parent's equity balance plus any non-controlling interest. In other words, if I were to buy 100%, in truth, what I invested equals what their equity is. Now, the subsidiary's equity would be through debits, right? We're eliminating the equity section of their balance sheet. That's a credit entry normally. So we're going to debit it to get rid of it. Next, the in. Well, the I is the investment in subsidiary. Remember, the parent will show that on their books. This is an investment like any other. We mentioned that for internal purposes, companies will usually track this as an equity method investment. And so they have that investment account. But that gets eliminated. Otherwise, we'd end up double counting. Same problem if we didn't eliminate the subsidiary's equity. Now, for some entities, if they're wholly owned, that's it. I effectively would equal or be most of that CAR, and there won't be a non-controlling interest. However, if there is a non-controlling interest, i.e., a company or companies, party or parties that controls not a majority, but does control some piece of the company, they have an ownership stake, well, we're going to make that appear based on the fair value of their stake. And then finally, we have to deal with big. One of the other key attributes is that when we acquire a company, we do so at fair value, not at historical cost, fair value. So in order to make that right, we have to take the subsidiaries' books, which are at historical cost or other bases of accounting, and update them. We have to fix them to fair value. Well, we can categorize that into three groups. One is the balance sheet. What the subsidiary does have recorded is adjusted to fair value. For example, if the subsidiary had a building, well, that building might be on their books for $1 million because they bought it several years ago, but now it's worth $2 million. We need to adjust that building in consolidation to $2 million because we bought it based on its fair value. That's one category. The second are items that don't appear on the subsidiary's balance sheet, but nonetheless have value that we can attribute to them. Remember, there are plenty of intangible assets that are not allowed to be recognized by a company if they're internally generated. However, if they're bought, i.e. in an acquisition, we can assign value to such an intangible asset. So that's how these would then appear, as it says, identifiable intangibles. Then we end up with, well, the plug. Once we figured out what we are spending money on, we can say, well, we spent it on the book basis, the net assets of the company. And then what? Well, I spent it on the fair value of those net assets. And then what? Well, I spent it on intangible assets that weren't even on their balance sheet but have value to me. And then what? Eventually you run out of and then what? So you don't have anywhere else to put it. That's when we end up with, well, I have nowhere else to go with it. It must go to goodwill. And that's the plug figure. It's this additional value that I can't particularly express on a balance sheet. A lot of folks will say, well, goodwill can be, well, like the name implies. Maybe it's the reputation of the company. Maybe it's the collective know-how of all the folks who work there. Maybe it's their customer base. Who knows? But the point is, as the buyer, I said, it has value. I am willing to pay for it. I'm willing to pay for that recognition, that reputation, whatever it might be. And so it's appropriate in consolidation to assign value to it. Now, in the rare case that you're able to purchase a company at a discount, that would mean that the G in this case would be effectively negative. Well, what do we call negative goodwill? Now, some have said, well, how about badwill? And no. Well, it's still a G. It actually works with a mnemonic. It just becomes an effective gain. Remember, the reason I said car in big, I mentioned car is eliminated with debits. IN, those are debits. We're going to eliminate those with credits. Big are more debits. Normally, the G being goodwill, it's an asset, would appear as a debit. But if it's the other side, it becomes a credit and it's a gain instead. Now that's unusual. I might even go so far as to say rare, but that's how it's handled. So put it all together and a prototype journal entry, EJE, would look like this. So you'd have debits to CAR, credits to I, and if there is a non-controlling interest, the N, and then debits to B, I, and G. Now, note that some companies may not have any B or I. Maybe they said, no, we paid exactly what it's on their books for. We don't have any fair value adjustments. But if there are, then we're going to have the B and the I, and if there's any plug left over, we're going to recognize goodwill. That's the G. Now, a couple other ways visually to think about this. I like this one. So the idea is that the subsidiary has value, and that value is supported, or there's a foundation underneath it. Or if you wish, you could say, what does the subsidiary have, and how did they go about getting it? Well, what they have is they have their book value, right? They have the book value of their assets minus their liabilities, which means the book value of their equity. They also have certain things on their balance sheet which are worth more than it's on their books for. They may also have intangibles that aren't on their balance sheet at all, but do have fair value. And there's other value that we can't assign to anything specifically, but is nonetheless there. That's what the sub is effectively worth. That is its total fair value. What's that supported by? Well, it's the combined investment, right? It's the investment from the controlling parent, its investment in the sub, that's the acquisition price, plus anything owned by the non-controlling interest parties. That's what supports it. So we can look at it as a scale, and that's why you'll notice on one side of the scale is the car and the big, and on the other side of the scale is the I and the N, which represents the debits and the credits. Or, if you prefer, we can do it more as a kind of extensive math problem. And here we've added in some words to make that car in big mnemonic a sentence. The car I'm in is big. So the idea is that add up CAR, subtract IN, whatever is left over, that difference, is assigned first to the balance sheet based on fair value. If you still have more to go, then it's assigned to any identifiable intangibles. If you still have more to go, then it's assigned to goodwill, or if it happens to be a bargain, it's assigned to the gain. So that's a few different ways to think about it. Now, am I saying you need to memorize all of them? No. What we find is that each student one of these will resonate perhaps more than the others, and that's perfectly okay. That's what we want. So whichever one you look at and just intrinsically makes more sense to you, I want you to remember that one. That's what will help. But they're all built around a method to remember all the ingredients of this critical eliminating journal entry. Another way to look at it is exactly how we come up with those differences. So I'm certainly paying for the book value. If I pay more, I'm paying the fair value of all the subsidiaries' net assets, whether they are existing just at a lower number on the balance sheet or they don't exist on the balance sheet because they are more likely than not internally generated intangible assets. But anything I pay above and beyond that represents the goodwill. Bear in mind, the fair value of the subsidiary in total is based upon what I paid for my piece and what the non-controlling interest has as well. It's what we refer to as the full goodwill method. All right. That gives you what you need to know in terms of CAR in big as the foundation eliminating entry that we have to accomplish when we're consolidating the parent and the subsidiary. But we've got more stuff to cover, so we'll see you on the next one.